You're about to uncover something most people don't even realize. Did you know banks are actually not happy when you save money? Sounds crazy, right? We're all taught that saving is smart, especially here in the US, where everyone praises savers. But here's the twist. Once you hit a certain level of savings, specifically $50,000, the game changes. Let me tell you something interesting. Most people think banks love savers, especially in the US, where saving is considered responsible. But once someone hits around $50,000 in cash, the relationship changes. Not for the saver, for the bank. $50,000 isn't rich. It's not retirement. It's just the first level of financial security. But inside the banking system, $50,000 creates tension. Why? Because banks in America don't earn much from savers. They earn from borrowers' mortgages, auto loans, credit cards, personal loans, business credit, student debt. That's the engine. That's where profit comes from. So when someone keeps $50,000 in a savings account and they have no debt, the bank sees money that isn't doing anything for them. Now picture a normal Monday morning at a US bank. A customer checks their account. $50,000 in savings, no balances, no financing, just sitting. To the bank, that might as well be a parked car with the engine off. It looks nice, but it doesn't move. And if it doesn't move, it doesn't make money. Savings interest stays low, inflation stays high, everything from groceries to rent gets more expensive, but savings barely grow. And once a saver notices that, they start asking questions. And banks don't like those questions because when savers realize inflation outpaces interest, they begin to understand the system. Inflation quietly reduces the value of cash. The bank doesn't mind. It pushes people toward loans, credit, and spending. A saver with $50,000 isn't doing that. They have something banks dislike: options. Options mean you don't jump into a car loan. You don't swipe a credit card out of stress. You don't panic buy when life happens. Options give you patience, and patience breaks the cycle of debt. But there's something even more powerful: confidence. Someone with $50,000 gains financial confidence. They can negotiate. They can decline offers. They can wait for better prices. They don't need to accept whatever is available. Confidence lowers dependency. Lower dependency means less borrowing. Less borrowing means less profit for the bank. Now compare that to someone with zero savings. Suddenly the offers start rolling in. Credit cards, buy now, pay later, auto financing, upgrade loans, promotions everywhere. Why? Because someone with zero savings is more profitable. They rely on payments. They rely on credit. They rely on financing. Zero savings is good for the bank. $50,000 is stability. And stability doesn't make money. That's the real reason banks dislike people with $50,000 saved. Not because the number is big, but because of what the number represents. The beginning of independence, the ability to choose, the power to wait, the confidence to avoid debt, and the freedom to stop playing the bank's game. $50,000 is the first door out. And once someone walks through that door, the bank loses the one thing it depends on the most: control. Want to learn more about how money really works behind the scenes? Subscribe now and unlock the truth behind the financial system. Get the latest insights into how banks profit from your debt. Hit that bell icon to stay informed. Don't let the bank control you. Take back your financial freedom starting today.